In this video, we're going to be doing a brief analysis of Caterpillar stock, ticker symbol CAT, which is the 9th position in my portfolio by market value. Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and if you are new here, I make videos about personal finance, investing, the stock market, and all of those topics, and I show you guys all of the things that I'm investing in my dividend portfolio, and I'll give you monthly updates and things like that. So if you guys are interested in this content, make sure to subscribe so you don't miss out on any future videos, and like this video as well. It really helps support the channel, and I appreciate that a lot. So Caterpillar stock is one that I've been a fan of for a while, but we're going to do a little analysis and look at how they're doing, and try to consider what the valuation might look like and if it might be a good time to buy. Alright, so first we're just going to take a look at the company and what they do. So just looking on their investor relations page, they say Caterpillar is the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel electric locomotives since 1925. We've been driving sustainable progress and helping customers build a better world through innovative products and services. And then they go on to talk about their different segments, which are construction industries, resource industries, and energy and transportation, and they provide financing and related services through the financial products segment. Alright, so we're just going to look here at some of their fourth quarter results and full year 2020 results. So it says strong operational performance. That's a subjective statement, I guess, but they said fourth quarter 2020 profit per share of $1.42, adjusted to $2.12, and their full year operating profit margin of 10.9%, with an adjusted margin of 11.8%. And then they returned $3.4 billion to shareholders through dividends and share repurchases, which is great to see as a shareholder. So sales and revenue for the fourth quarter were $11.2 billion, which is a decrease of about 15% from the fourth quarter last year. And then profit margin was 12.3%, which was about a little bit of a decrease, whereas it was 14.1% in the fourth quarter last year. Then this year, the fourth quarter profit per share was $1.42, like we said, compared with $1.97 last year in the fourth quarter. And they say fourth quarter 2020 adjusted profit per share of $2.12 reflects strong operational performance and a lower effective tax rate. So lower tax rates are good to see as a shareholder. So they talk about full year sales and revenues now, which was $41 billion, which is actually down 22% compared to the almost $54 billion in 2019. And they said the sales decline reflected lower end user demand and dealers reducing their inventories by $2.9 billion in 2020. So there was basically less demand for their products, probably because of the pandemic to some degree, and dealers did not want to hold as much inventory if they were not going to sell that as quickly as well. And they said operating profit margin of 10.9%, compared with 15% for 2019, 15.4% that is. So that's a pretty substantial decrease. And then the full year profit was $5.46 per share, compared with $10.74 per share in 2019, which is a pretty drastic decrease. And then the adjusted profit was $6.56, compared with $11.40 in 2019. So that's definitely not good to see. The CEO says he's proud of the global team's resilience in navigating the pandemic while continuing to provide the essential products and services the world needs. Our fourth quarter and full year results reflect the team's agility in a challenging environment while executing our strategy for long-term profitable growth. We achieved the adjusted operating profit margin established during our 2019 Investor Day while continuing to invest in products and services. We are well positioned for the future and will emerge from the pandemic as an even stronger company. And I think that's definitely true. One of the things I've noticed from reading some of the reports that these companies are putting out about 2020 is basically their business has gotten more efficient as a result of the pandemic. So moving forward into the future, they'll be able to continue those efficiencies. And then they make a note on cash flow for the full year of 2020, operating cash flow of $6.3 billion, and of that they paid $2.2 billion in dividends, and then they used $1.1 billion of that for share repurchases. And they say liquidity remains strong with an enterprise cash balance of $9.4 billion at the end of 2020. So I also want to look at debt, because I think that's an important thing to be aware of with the company. So This is actually a list of the contractual obligations, so it's not necessarily just debt, but it's just things they have to pay out within the next year. They list for 2021, and then combined 2022, 2023, and then combined 2024, 2025, and then after 2025. So the most important for the short term, I guess, is 2021, but you also want to look at how those numbers are comparing moving out into the future. So they have some long-term debt, about $9 billion that is due in 2021. So that's I would say that's fairly substantial compared to the amounts that are due per year in each of the years following. And then they have some post-retirement benefit obligations. So that's not necessarily debt, but they're still going to have to pay that out. So that's one of the things they have to be aware of. And then purchase obligations. I think this is, for their actual products that they're making and, purchasing materials, stuff like that. And then they have interest that they're going to have to pay out and some of their various things. So basically, their total contractual obligations for 2021 are $22.8 billion. And then it looks like, at least for the time being, that they're going to owe around $7 billion per year. So, well, probably less than that. So 2022 to 2023, it's 14.2 billion due in that time period. So that's about 7 billion per year if you just take the average. And then 2024 and 2025 is about 7 billion. So that's 3.5 billion per year. And then after 2025, there's additional 19 billion due. So overall, I think that's definitely not looking too bad because obviously they're probably going to be struggling a little bit after the pandemic, and they're going to have to, just plow through and continue going. And, maybe it won't be the prettiest for the next year or so, but I think they're going to continue doing very well in the next few quarters. And I'll be looking forward to hearing how they do in the next few quarters. So now we're going to look at the dividends. This is in my dividend portfolio, so we want to be aware of this. This is Caterpillar stock. They're actually up 4% on Friday, March 12th. Which was pretty incredible. But if we look here, the yield is fairly low at 1.8%. And as we'll look at the stock price in a minute, the reason that yield is so low is just because the stock price has just been going absolutely ballistic in the last 6 months to a year or so. That's definitely not a bad dividend yield considering how much capital appreciation we've gotten recently. And then the payout ratio is around 50% based on earnings per share. I think that's what Seeking Alpha uses. And then the 5-year average dividend growth rate is around 6.5%, which is right around what the average of my portfolio is. So I would definitely love to see a great dividend increase in 2021. And I actually don't think they increased their dividend in 2020 so far. We can look at that history real quick. So they will have to increase their dividend in 2021 to keep that dividend aristocrat streak alive. It says right here that the dividend growth is only 7 years, but my records indicate that they've been growing the dividend in 26 years. And if we look right here, this is a Motley Fool list of all the dividend aristocrats, and Caterpillar is on that list, and they say that they have 26 years of increasing dividends. So that is what I thought. So that's just to confirm that they are a dividend aristocrat. And then we're just going to check out the dividend history to show that they still need to make that increase for 2020. So if we look here, they increased it pretty substantially in the middle of 2019, and then they have not increased it in 2020, but they still have their streak alive because if you add up all the dividends they received in 2019, it's going to be about, what is that, $2.06 from these two, and then we got about $1.72 from these two, so then that is $3.78, I think, that they paid out in 2019, if that math is correct. And then multiplying this by 4, we get $4.12. So the total amount they paid out in 2020 was definitely higher than what they paid in 2019. So as long as they increase it at least once in 2021, they'll be able to have a larger amount in 2021 and keep that dividend aristocrat streak alive. And if we look at the stock price, they were up about 4% on Friday, which is pretty good. And then we can see over the past 6 months, they're up a pretty crazy 50%, 49%. And then over the past year, it looked exceptionally well because a year ago was pretty much pretty close to the bottom of the March crash. So from a year, they were up about 145%, which is absolutely insane. So like we said, their dividend yield is around 1.8%. They are a $125 billion company, as you can see right here, sorry. The one thing that is a bit concerning, based on how much the stock price has ran up recently, is this PE ratio, which is around 43. So I would say from that metric, they're probably a bit overvalued. Obviously, you have to look at some other things, but we're going to compare that to the sector, because oftentimes the PE ratio of different sectors can vary. So we want to take a look at how that is compared to the actual PE ratio of the industrial sector. So Caterpillar is in the industrial sector, and the industry within that is this farm and heavy construction machinery sector, or industry, sorry. And another stock in that sector would be like John Deere. So I think John Deere's PE ratio is about 33, so that's significantly less than Caterpillar. But we can see here the average PE ratio for the farm and heavy construction sector is about 29. So you could say that Caterpillar is definitely a bit overvalued compared to that sector, or that specific industry within the sector, sorry. And then the average for the whole of the industrial sector is 42.85. And I'm not exactly sure how they calculated that. If I would hope it's on a market cap basis, so like a weighted basis, because otherwise this 141 PE ratio of the conglomerates industry would really be weighing this up. But I'm not positive how that's calculated, but from that perspective, Caterpillar really isn't very overvalued compared to the overall sector. So these are things to consider. Nothing here is concrete, obviously, and PE ratio is not always the absolute best way to value a company. So that's just something I like to take a look at to give me a quick idea of where the valuation might be. Alright, so we're going to look at the position that Caterpillar is in my portfolio as well. You can see here it's right in this row. I have about 0.26 shares. And those 0.26 shares are worth about $60 right here, and that's worth about 4.69% of my portfolio. And like we said, they pay a dividend of 4.12, so $4.12, sorry, which is 1.8%. And my yield on cost is about 2.46%, which means that I am up a little bit in my position. And then the annual dividend I'm going to receive is $1.08. So that's not too bad. If we look at the performance here and find Caterpillar, you can see that my cost basis, or initial equity, is about $43, which is at an average cost of about $167. So when I was buying Caterpillar, if I'm being honest, I didn't think they were great prices. I thought it was probably about fair value, or maybe slightly overvalued when I was buying it. But I thought it was a great company, so that's why I was buying it. But as you can see, we're up about 36% in my position. So that's pretty crazy, considering that, I personally thought it was a bit overvalued when I was buying it, but I just wanted to be invested in such a great company. So it's always interesting to look at those kind of things where you think something is overvalued, so you don't buy, but then it just keeps going up. And it's an interesting game to play and try to figure out what to buy at what time. So overall, I really do like Caterpillar as a stock and a company a lot. I definitely think they are a bit overvalued right now, just given the current valuation and such like that. I think one of the big reasons they've seen so much of a run-up recently is because of some of the government's plans and promises, or campaign promises to work on the infrastructure a lot, and that would definitely benefit Caterpillar, since they sell and produce a lot of the machinery that would be used in that infrastructure, and they also make a lot of mining machines that are necessary to get some of the materials for that infrastructure building. So it definitely could be part of the reason that we've seen such a big capital appreciation recently, but I think that is maybe a little bit overzealous, just because that's just what people are saying they're going to do, and there's no guarantee that's going to get done, so it's kind of not a speculation, but it's just not for sure, what's going to happen there. So I think, like I said, at the moment, they're probably a little bit overvalued, but definitely decide that for yourself. Do your own research, figure that out for yourself, not just from me, because that's just me, not you. You have to make the decision for yourself, and I think that's really important in investing. So the one thing to me that is a tad bit concerning is just the dividend and the fact that they did not increase it in 2020. But I think they probably could have. They just wanted to, be careful and not get too overexcited, So I think they'll definitely increase it in 2021. I'm really not too worried about that, but it's just definitely something to keep in mind as well. So let me know if you do own any Caterpillar. I'd be super excited to hear if you do, and if you're going to be buying any recently. I know some people have probably been selling a little bit recently just because they have some pretty great gains on it, so that's definitely okay as well. Just let me know what you guys are doing. If you do want to check out some other videos I've made, I will leave some right up here. You can check those out, and I would really appreciate that. But I do not think I have anything else for you guys today, so I will see you in the next one.